Welcome to the fascinating world of cryptocurrencies, where perplexity and burstiness intertwine to shape the future of investments. Coined in the aftermath of the 2008 financial crisis, cryptocurrencies have skyrocketed in popularity, driven by the revolutionary blockchain technology. As investors ponder over the tax implications of these virtual digital assets in India, we delve into the depths of crypto taxation, decoding its impact on investments and returns. Join us on this enlightening journey as we navigate the intricacies of the crypto tax landscape. The genesis of cryptocurrencies took place after the financial crisis of 2008, leading to their widespread popularity in recent years. Cryptos, founded on the revolutionary blockchain technology, have emerged as a hot favorite among investors worldwide. Nonetheless, the question of whether investing in this asset leading to their class is a prudent choice remains a never-ending debate, particularly in the wake of India's announcement of taxing cryptocurrencies. If you currently invest in or plan to venture into the world of cryptocurrency in India, taxation assumes paramount importance in shaping your investment decisions and potential returns. Let us delve into the intricacies of this crypto tax regime and its potential implications. Unraveling crypto tax. In the budget of 2022, Finance Minister Nirmala Sitharaman introduced new tax regulations concerning investments in cryptocurrency in India. According to these provisions, cryptocurrency is now classified as a virtual digital asset, VDA, subjecting it to taxation. Notably, this classification extends not only to cryptocurrencies, but also encompasses NFTs. The new rules decree the following. VDAs are to be treated as assets, and will thus be subjected to a flat tax rate of 30% when transacted, leading to income generation. In contrast, other assets like land attract a long-term capital gains tax, LTCG, of 20%. Additionally, a 1% tax deducted at source, TDS, will be levied on all VDA transactions, regardless of their profitability. Losses incurred in VDA transactions cannot be offset against profits derived from other assets. If a transaction amount falls below 10,000 rupees, TDS is not applicable. Nevertheless, it's essential to note that these thresholds apply to individual users across all platforms used for trading. Since MudRex lacks visibility into transactions across other platforms, TDS will be deducted from the first eligible transaction starting from July 1, 2022. However, if the cumulative transaction amount across exchanges remains below 10,000 rupees, users can claim a refund of the TDS deducted. The implementation of crypto tax on gains commenced on April 1, 2022, while the deduction of TDS from transactions was initiated on July 1, 2022. The intent behind taxing cryptocurrencies in India. The imposition of cryptocurrency taxation in India reflects the government's inclination towards fostering a favorable crypto ecosystem within the country. Many speculate that this step could be the precursor to more comprehensive regulations governing cryptocurrencies. Presently, the lack of well-established laws concerning data protection leaves investors vulnerable to fraudulent activities. Furthermore, the absence of concrete regulations provides a safe haven for money laundering and the funding of illicit activities. Additionally, the government aims to prevent cryptocurrencies from posing a competitive threat to the Indian rupee to US dollar exchange rate. While cryptocurrencies may not be legal tender in India, the option to trade and invest in them remains open to the public, making it possible for anyone to hop on the crypto bandwagon through platforms like MudRex CoinSets. Unraveling the taxation of cryptocurrency in India. The Finance Bill of 2022 introduced new provisions that warrant close attention before engaging in any cryptocurrency transactions. Let us elucidate this with an example. Assume Tony purchased Bitcoin worth 20,000 rupees 5 years ago and decided to sell it now. As per the new crypto tax regulations, any gains resulting from this sale would be subject to a 30% tax. Importantly, Tony cannot deduct any expenses incurred during the initial purchase of Bitcoin to reduce his taxable profit. Hence, if he sells Bitcoin at 60,000 rupees, his taxable gain amounts to 40,000 rupees. Consequently, due to the 30% crypto tax, he will be required to pay 12,000 rupees. Additionally, since the transaction amount exceeds 10,000 rupees, he will have to pay a 1% TDS amounting to 600 rupees. Tony can claim a refund of the TDS when filing his taxes if the cumulative transaction amount within the financial year remains below 10,000 rupees. Conversely, if Tony's deal resulted in a loss, filing it can enable him to receive a refund, provided it meets the specified criteria. Notably, the crypto tax regulations explicitly state that Tony cannot offset his losses against profits from any other assets or income, including digital assets, equity, and real estate. Moreover, he cannot carry forward the loss to the next financial year to offset potential future gains. These rules differ from those applicable to other financial assets. For instance, if Tony incurs a loss on the sale of company, a stock, during an FY, he can offset it against income from other investments, such as the sale of company B's stock in the same FY. If he has no gains to offset the loss, he can carry it forward for up to 8 assessment years. However, this flexibility does not extend to cryptocurrencies. Intriguingly, the rules do not hold true for cryptocurrencies. They follow a separate trajectory, underscoring the need for investors to stay well informed about how to calculate crypto tax in 2023. When to settle tax on cryptocurrency transactions in India. Crypto tax liabilities will commence from the assessment year 2023 to 24, affecting not just sales, but nearly all transactions involving cryptocurrencies. Some of the scenarios warranting tax payments on crypto in India include selling cryptocurrency. As previously mentioned, selling crypto triggers a 30% tax on gains, and a 1% TDS is deducted from the transaction amount. Mining cryptocurrency. Mining crypto qualifies as a self-generating capital asset, and while mining itself is tax-free, the subsequent sale of mined crypto becomes taxable. Nevertheless, taxpayers can deduct the cost of acquiring the crypto through mining. Trading cryptocurrency. If you frequently trade crypto, and it falls under business income, GST may be applicable. However, if you treat crypto as an investment, profits from sales are considered capital gains and taxed accordingly. Receiving crypto as a gift. Receiving crypto as a gift incurs a 30% tax, along with cess and surcharge at the recipient's end. Staking rewards, airdrop of crypto. Both activities entail acquiring crypto as a gift, necessitating the payment of taxes at the recipient's end. Receiving crypto as a salary. In such a scenario, the recipient is taxed at 30%. Thus, incorporating crypto into one's salary structure might not be a wise decision unless the individual is already in the 30% tax bracket, in which case it would have no additional impact. Tax implications of holding cryptocurrency as an investment in India. Holding crypto as an investment in India and deriving profits from it qualifies as capital gains. Such gains can be categorized as short-term gains. If crypto is held for less than 3 years, tax is levied based on the individual slab rate. Long-term gains. For crypto held for more than 3 years, profits fall under long-term capital gains, attracting a 20% tax. Notably, even if a crypto transaction results in a loss, the taxpayer is still obligated to pay TDS. The future of tax implications under the crypto bill remains uncertain, as the government continues to examine digital assets. Taxation of lost or stolen cryptocurrency in India. As of now, specific and explicit provisions for taxing lost or stolen cryptocurrency do not exist in India. Potential cases of higher taxation on cryptocurrency in India. Beyond the flat 30% tax on crypto gains, certain scenarios might result in higher taxes on cryptocurrency in India, including 1% TDS on all crypto transactions, GST implications if crypto sales are treated as business income, though a definitive set of rules is yet to be established, paying a 30% tax when receiving crypto as a gift, with the same tax rate applicable upon future sale. Potential double taxation in the case of rewards or airdrops, where tax is paid both upon receipt and subsequent sale. What does this mean for investors? The introduction of new tax regulations may add to the cost of investing in cryptocurrency, but it also presents upside potential. Cryptocurrencies like Bitcoin, Ethereum, and Tether have historically delivered substantial returns over the years. Despite the inherent risks and limitations of this digital asset class, making informed investment decisions through diligent research can enable investors to diversify their portfolios and build long-term wealth. In conclusion, India has witnessed a significant surge in the number of individuals exploring crypto investments, with the figure reaching 15 to 20 million and still growing despite obstacles. While the imposition of crypto tax in India may be perceived as a challenge by investors, the tax implications remain uncertain, awaiting further clarity from the crypto bill. The government acknowledges the potential of digital assets, as evidenced by the launch of the digital rupee in the same union budget. Nevertheless, safety regulations concerning cryptocurrencies need improvement, a crucial aspect that the authorities must address. FAQs. Do I need to pay taxes on my crypto assets if I haven't generated any profits in this fiscal year? No, if you've incurred losses on your crypto sales, or have not sold them at all, HODL, you are not liable for crypto taxes during this cycle. How do I determine my TDS liability? You must pay 1% TDS on all crypto transactions. However, if your cumulative transaction amount in a financial year remains below 10,000 rupees, you can claim a TDS refund while filing your income tax return, ITR. Mudrex investors can now access their TDS report on the app. How much tax is levied on cryptocurrency in India? For any cryptocurrency sale, transaction, or transfer, a flat 30% tax is applied to all gains. Additionally, a 1% TDS is deducted. Depending on the type of income, such as business income, GST may also be applicable. Officials are deliberating a potential 28% GST rate, though a final decision is yet to be reached. Are the taxes lower if my crypto profits are long-term capital gains? According to India's crypto tax regime, whether your gains are long-term or short-term capital gains, you are taxed the same. What are the consequences if I fail to file my crypto taxes? Not filing crypto taxes is considered an offense and can result in serious consequences, as TDS is already deducted during transactions. Additionally, KYC documents are submitted when opening an account with a crypto exchange, which the exchange reports to the authorities. Non-compliance may lead to receiving notices from the Income Tax Department and further complications if cooperation is lacking. As we draw the curtain on this exploration of cryptocurrency taxation in India, one thing remains certain: the evolving crypto landscape promises both challenges and opportunities for investors. The taxing of virtual digital assets opens the door to a regulated crypto ecosystem, yet the lack of definitive rules leaves room for further clarity. As India continues to navigate this dynamic realm, one must tread carefully while embracing the potential for diversification and wealth creation. Thank you for joining us on this insightful quest into the world of crypto taxes. If you enjoyed the content and found it helpful, please give it a thumbs up or hit the like button to show your appreciation. Sharing is caring. If you think this information could benefit others, consider sharing this video or article with your friends, family, or colleagues.